Another big night, a very difficult night for a lot of people out there, pension funds, state pension funds, companies. And Guy, I think probably the question to you and everybody else around the panel and to a lot of our viewers who may not be market pros tuning into CNBC for the first time in a couple of, time because of what's going on. Do you sell now if you still own stocks? Do you ride this out? Do you see any kind of a sign of a stock market bottom?
Well, you mentioned the bond market turning. I mean, you can interpret that as a good sign. Maybe the bond yields, which probably let us down in the S&P, maybe the fact that yields seemingly are starting to rise a little bit, maybe they'll lead the S&P 500 up. But to answer your question, now's really not the time to do a whole lot of anything. If anything, now's the time to try to understand what's been going on in the world for the last 6 months. So maybe you can get up get up to speed as to the reasons why. Now, a lot of people, correctly, maybe not correctly, will say, obviously, Guy, this is all coronavirus. See, I would say that's not the case. I think the coronavirus was the match that led the tinderbox that this has been sitting on for the last year or so. So try to understand the reasons why. But to try to trade the market here, even the oldest of pros that have been doing this for a long time are having difficulties. I think traders have been trading, varying degrees of success. But if you've watched it so far, try to understand why, try to see where the companies you own are, and try to understand if their businesses are going away, which they probably aren't, or if this is just another 20% downturn over the years that we've seen maybe 3 or 4 times in the last decade or so.
So a couple things that I think are worth noting at a time like this in the market, and they're mildly complicated, or I don't want to make them too complicated. But, Guy said, I'm not sure what you do. If you are concerned about your exposure, one of the things that doesn't really work are index shorts at this stage. You get to a place where after an extreme sell-off, index shorts stop working, and you need to find single stock shorts to match your volatility with actually the long side of your book. That's just something to throw out there. When you think about what the market has done, and today we closed below the lows of 2 days ago. This is a case where I think markets are still trying to find that level. There's no question the velocity of this move is what makes this extraordinary. And I go back to, this reminds me of that 2011 analog where early first 7 or 8 days of August, we went down about 9%. Then we chopped around, and then we had these moments where we went down 4%, up 4%, down 4%. And this went on until the markets started to seem, but we still had a growth scare. And at that point, after the oversold markets rallied very hard, you were then confronted with a macro setting that wasn't so great.
Yeah, I would just say it's not just the velocity, it's actually the aggregation of all of the moves. When you look at, you guys talked about rates. I mean, the 10-year Treasury yield was just under 2% at the start of this year, and what did we get down to? 40 bips or something 31. Like that, or 31 bips on Monday. That was a crash. That was like probably the most shocking thing that has happened this year in risk assets globally. And then you put in obviously what happened with crude over the last couple of weeks, crescendoing yesterday, but still going lower. So you put that together, the dollar, obviously that move was pretty significant. That was a crash of financial markets. There's no way to sugarcoat that. But getting back to single names, I kind of agree. There's going to be some amazing opportunities. Guy mentioned something that, you got to focus on the companies that are going to be around. There will be some companies that are just not investable. Cruise lines are going to be one of them. I just can't imagine.
You don't think so? Not yet. Well, not ever?
Well, it's going to take years. I mean, but think this might be, we've been talking about the overstored in retail. We've been talking about department stores. Macy's is becoming a very distressed balance sheet. Why would you buy that? This could be the final thing. So I think that you want to focus on things like Disney that are going to be around. It's down 30% in the last couple of months, and you figure out how to start legging into something like that when their parks come back online, their movies are back in stores, and the consumer is back.
I agree with everyone's been saying. I think you got to know what you own. To me, when I try to figure out what do I own, I look at the balance sheet first. What is their debt situation, right? How long can they afford to ride it out? So Google, which I bought some Friday, obviously that was too early. I look at that balance sheet as probably the premier balance sheet in the world right now. Same for Facebook. And then, Target in the retail space. They do have debt, but this is not it's not a concerning amount of debt at all. So that's important to me. Disney actually has some debt. Yeah. I do love the name. I am waiting for a big down Disney day. But one of the things...
This is not down enough. Does anybody around the table believe that what has happened the last couple of weeks with equities is an overreaction?
Well, if you look at the bond market, it's not. If you look at credit markets over the last 3 weeks, really the last 10 days, it's not. If you look at where valuations were before we had the sell-off, it's not. If you look at the prospects for earnings, it's not. If you look for, essentially how overbought we were as a function of central bank goosing monetary policy, it's just hard to say. I don't want to be so perversely negative. I think what we're saying is there's great, like Starbucks. Starbucks was bludgeoned today, down almost 9%, because obviously now you're getting to literally the numbers of people that are not going out. They're not getting that morning cup of coffee. They are not going to work. Where do you get your first? You're on your work. You grab your Starbucks. That's a great company that I want to own. And in fact, somewhere in here, this is again one of those names. Oh my goodness, I didn't think I'd see it at these levels.
It's a reaction. I don't think it's an overreaction. And we've said this for a long time on the show, and it plays out over and over again. Markets go down much faster than they go up, and now they go down even faster than they have historically. That's just the way the market's built. So it feels bad. But if this were to happen over a 3 or 4 month period, would we be having the same conversations? No. Now you have to ask yourself, right, what levels make sense in terms of the broader market? And I will tell you that although I don't think we get there, that 2410 level, which we saw in December
Christmas Eve.
Exactly. I mean, that is really the level that I think people sort of have a bullseye on. And we've mentioned this for quite some time. The Russell, as measured by the IWM, that never validated the move in the S&P to the upside. Now it's below that 128 level that we talked about forever. That's something you need to continue to watch. So if the Russell were to ever turn with the bond market, maybe that gives you some assuage some concern.
I hear what you're saying, and I'm a believer in technicals. Been doing this 25 years. I'm a believer. But I do wonder. Technicals are for sort of pros and semi-pro. I do wonder if mom and pop at some point just gives up on equities again, like they did in 2008. They say, cash out, I'm done, I can't stand the pain. They won't care about technical levels. I don't know.
Except for the fact that, the late 2018 destruction, it was 20% in a very short period of time. I guess it was about 2 months or so. I mean, those are the sorts of levels you got to kind of, if you're looking to put some cash to work and you say to yourself, I'm kind of in no man's land right here, you'd say, okay, maybe we have a crescendo towards that low at 2350 where the market not only stopped going down in December 2018, but launched an epic one-year rally or maybe an 18-month rally or so. I just make one other point, to your question, though, Sully, about whether it's an overreaction. The stock market, the S&P 500, is basically back to January 1st, 2018. That was the year that the tax cut went into effect. That was a $1.5 trillion tax cut that was basically money borrowed from the future and just handed to corporates. You know what they did over the next 2 years? They bought their stock back, about $1.5 trillion worth of stock in 2018 and 19. So we're seeing a lot of unwinds here in a way, and it's not too different than we were talking about with rates. Everybody wanted lower rates. Everybody wanted lower commodities. Well, when they got them, to Guy's point, it wasn't a great thing for risk assets across the board.
No, and I want to go back to Boeing. We highlighted that at the top of the program, and nobody again is sort of trying to dump on Boeing. But Karen, you mentioned, I think, something incredibly important about balance sheets. And here's the thing about Boeing, and there's all this news about the MAX. We know that. There's about order cancellations. We understand that. There's things like pension obligations that when you do your actuarial tables and you look out at equity gains and you look at interest rates, they destroy those actuarial tables. These are companies with real obligations. And I'm not picking on Boeing again, but it fell 18% today. And in the depth of the financial crisis, Boeing had a negative book value of $1.2 billion. Today, Boeing has a negative book value of $8.6 billion.
I mean,
balance sheets matter.
They do matter. I mean, we've heard about Boeing drawing their revolver down, which was smart of them to do, so to get more cash in. I mean, GE, all the big companies, they have the same issue. GE's pension obligations on paper just got a lot higher as interest rates
still
go
positive
down.
balance. I looked at all the top, AT&T, GE, IBM. I did look at all those today with huge fixed defined. And there are, by the way, there are still companies with pensions. We need to remember that. They're all still positive book value. I wonder to say something about maybe the bottom of Boeing, or is this something more we need to worry about?
I don't own Boeing. I think it's, I mean, even having come in this much, I feel like, wow, with what's happened to the airline industry, what's happening in the economies around the world, that there's more downside for Boeing. I mean, at some point it is cheap, but everything's getting cheap. Boeing is cheap relative to where it's been in the last year and a half. but everything's getting cheap.
Let me just throw a comment in here. So Boeing, their peak earnings in 2018 were $16 a share, okay? And that basically went, down fairly dramatically, at last year. But next year, right now, they're expected to maybe, this is consensus, and it could be lower. To your point, we just don't know, and there's no visibility. But this is a company, from a cash flow basis, from an order standpoint, that people would say, Tim, you would have said this a year ago, take it to the bank, right? And so here's the thing. You got to start thinking about, if a company like Boeing can get back to peak earnings in the out year, then you can start valuing it. Then you could say it's trading at about 11 times that, right? And you would say, this is when I would start picking or dipping my toe in the water. That's how you would buy a company like this that's just seen the perfect storm. This stock was above $300 just how long ago? It's down 50% in a short period of time. Boeing's going to be around, and those orders are going to come back in one way or another. So that's how you have to start thinking about it a little bit, and you're going to have to take some risks. That's what this whole game is.
The Boeing's, sorry, go ahead. The Boeing situation is a combination of where we went into this downdraft, but also just the reality that they went from a free cash flow machine to having quickly levered up. They wrote down $5 or $6 billion in the fourth quarter. I have to check that number. It's somewhere around there, and they have to issue, and they will be issuing massive debt this year. Ultimately, when they start generating free cash flow, priority is going to be debt paydown. But their leverage, their gearing has changed almost overnight. This went from being a company that was extremely cash flow positive, $25 of free cash flow a share, to one that's actually changing the gearing to probably getting close to 2.5 times. And that's something that the market doesn't like.
Yeah, and they've bought back stocks that changes book values, but it is a number that has been getting some attention out there on Boeing, and nobody's picking on the stock. But given that it is still, I think, the highest dollar value stock in the Dow, it does have an outsized impact on the price. And I know the Dow is not what we should be looking at as pros, but it is what is making the headlines. And the stock market now, Guy Adami, is dominating the general news.
No question about it.
You watch the 6:30 nightly news, and they're leading with the stock market, and the Dow is what the sort of the American looks at.
Understand. Listen, I totally get it. And let's quickly, I think this is important. The S&P 500, the Dow Jones Industrial Average, is probably down from the recent all-time high to current levels anywhere from, 19.5% to 20.2% or thereabouts. So people might be watching this and saying, well, the market's 20% cheaper. And the Dow Jones that you just mentioned, okay, it is. But that doesn't mean that stocks are cheaper, because the stocks are valued price to earnings. And again, nobody out there, and I can tell you what earnings are going to be. So I can make an argument, and I've said this a few times, that stocks today might be more expensive than they were 2.5 or 3 weeks ago. That's just something you have to get your head around. So what's happening is the market is recalibrating at an extraordinarily fast pace. But I know, as painful as that is, it's not necessarily a bad thing.
No, at some point there'll be buys, and at some point you're gonna find companies that probably fell more than they should have, and generational wealth will be recreated because everybody wishes they bought March 6th, 2009. We don't know if that time is here yet.